Hi and welcome to The Pitch, brought to you by Livewire Markets. I'm Hansley, and joining me today is Gopi Karunakaran of Ardea Investment Management. Ardea are specialists in a specific kind of fixed income investing called relative value. So to start with, Gopi, what in as simple terms as possible is the concept of relative value investing?
Sure. So our universe that we operate in is global interest rate markets. So that's government bonds and some derivatives related to those government bonds. Now, what's interesting to us as relative value investors is in this market, you have a unique feature that you don't see in other markets, which is that you have lots of securities that are ultimately all related to each other by some kind of well-defined pricing relationship. So what relative value, or what we call pure relative value investing, is all about is recognizing that there are these relationships, they're well defined, and if markets were perfectly efficient, then all these securities should always be priced consistently with those relationships. In the real world, of course, markets are not efficient all the time. And in rate markets, what you have is this phenomenon where you get lots of buyers and sellers who are there for other reasons other than profit. Like they're doing things for hedging purposes or matching liabilities, central banks for policy purposes. As they come into the market and they buy and sell, they create temporary demand-supply imbalances. And that is what creates a situation where two securities that are very closely related, have very similar underlying risk characteristics, become priced inconsistently with each other. And what we do is we take advantage of that, buy the cheap one, sell the more expensive one, and wait for those prices to align to a more consistent type of framework, and do that in a way that's market neutral. So that's very important. We're not trying to take a view on what's going to happen to the bond market or the economy or anything like that. We want to very precisely isolate just these relative price differentials.
And the profits you make are your spreads, right? Just to clarify between the two?
Correct, that's exactly right. And the key is repetition. So each time you do this, you're not going to make very much. These are small mispricings, but the key is do it over and over again. So it's turnover, it's velocity, and doing it repeatedly through time.
Got it. Well, that leads nicely on to a next question that I have. How does relative value, I guess as a concept, how is it different from the more conventional methods we're used to when we talk about fixed income investing, like duration, like credit?
Sure. Yeah, so good question. So we think of this in the context of levers, different levers you can use as a fixed income investor or an allocator to fixed income. And when you look at conventional fixed income, there are two levers. So you've got lots of different funds that have all kinds of different names, but when you decompose to the risk-return profile, it comes down to some combination of two levers. Lever one is what we call duration, and so that's sensitivity to interest rate changes. So government bonds would have a lot of duration in them. Lever two is credit, sensitivity to credit spreads or default risk. Corporate bonds would have a lot of credit. And so if you look at most fixed income portfolios, they are a combination of those two levers, and most of your return is coming from holding the bonds, earning the income, and having exposure to either interest rate duration risk or credit risk. We think of relative value, or pure relative value, as being a third lever in fixed income. Not as well known, but crucially different. So it's not dependent on the level of rates, it's not sensitive to duration, it's not involving credit, so it's something different. Not better or worse, different. And why difference matters is difference is what unlocks diversification.
Okay, so let's pass that then. Why is relative value investing then a more effective lever for generating returns?
Yeah, I'd say, again, the message that we give to clients, and certainly a lot of conversations we talk to clients, is around complementary fit. So traditional fixed income investments are very sensitive to the level of rates, the level of yields, what's happening in the macro universe. Whereas this third lever, relative value, is not sensitive. It's completely independent or uncorrelated, to use the technical term, to all of those things. And so putting those three things together can be very powerful, because in an environment where levers 1 and 2 may not be doing so well, so think about an inflationary environment like 2022 when government bonds got hit really badly. Think about a recession like the GFC where credit gets hit very badly. RV, or relative value, is not affected by those things in the same way, so it helps diversify portfolio risk.
I guess when you think about conventional fixed income, I just think during the last 2 years we've seen such a massive surge in volatility. I think of how bond markets can now move on one word from a central bank speaker, or I think of the SVB and Credit Suisse crisis and the massive fiscal deficits being run after COVID. How have you dealt with this volatility as an investment house, and does it actually make it more challenging for you to generate that alpha?
Yeah, so it definitely does make it more challenging at times, and dealing with the volatility is the key to doing relative value well. Because ultimately what we're trying to provide is a defensive type of investment. So it's no good to have an investment profile or offer an investment profile where in the good times we're generating alpha and then you get a crisis and we're down a lot. That's not fit for purpose, if you like. So vol control is crucial, and there are really at a big picture level, two ways that we control vol in those more challenging markets. What we don't do is try to take a view. We don't try to say, oh, well, things are looking bad, let's do X or Y, because we just have no competitive advantage doing that. We use portfolio construction. And what we do specifically is first we diversify risk in our portfolios. So just size your bets small is the basic idea. Lots of small independent bets and use the power of diversification. The second thing is a bit more nuanced, is this concept called risk balance. And this involves, without getting too technical, buying interest rate options and other things like that you know will do well in that stressed environment. And what we try to do with our portfolios is always have that bit of a balance there where you know in a stressed environment, some of the things are going to not go well, but you've got these other things that are biased to going well. If you get that balance right, then your portfolios should be able to sail through those. And that's the experience we've had. If you look at 2020 during COVID, 2022 during inflation, the portfolios held up pretty well.
Beautifully explained. Gopi Karunakaran there from Ardea Investment Management. And if you enjoyed that video, thank you for joining us, of course. If you enjoyed that video, please subscribe to both the Livewire and Market Index websites, as well as our YouTube channel. Thanks for watching.